Hey, buddy, come in. You're such a good dog. It is the spring of 2007. The housing market is at its peak. Stocks are climbing. The chairman of the Federal Reserve has just told Congress that the fundamentals of the American economy are strong. Every bank on Wall Street has a team of PhDs running models that say the same thing. The system is sound. And in a modest office in Midtown Manhattan, a hedge fund manager named John Paulson is sitting in front of a computer screen watching a number that makes no sense. His fund is up 66% in a single month. Not 6.6, 66. His investors called him convinced it was a typo. It was not a typo. By the end of 2007, Paulson's firm had generated $15 billion in profit, the largest single-year gain in the history of hedge fund investing to that point. He would add another $5 billion in 2008, $20 billion in 2 years, betting against the very system that every expert on television was telling you was fine. George Soros made $1 billion breaking the British pound in 1992. Paulson made $20 billion betting against American homeowners. Now, here's the question that nobody in mainstream financial media asked loudly enough after that trade. How do you make $20 billion betting that a system will collapse, unless you understand the system better than the people running it? Not better in the sense of more data. Better in the sense of a different framework entirely. A framework that says systems do not collapse by accident. They collapse when it is profitable for the right people to let them collapse. And the people who understand that framework position themselves on the right side of the trade before the collapse happens. That framework is what this video is about. Welcome to Engineered Markets.
Hi guys! Enjoy John's analysis.
And today I want to introduce you to a professor, not a trader, not a TV pundit, not a crypto influencer, who has been teaching a version of this framework in a classroom for over 2 decades. His name is Professor Jiang Xueqin. And his argument is one of the most uncomfortable, most structurally coherent, and most verifiable arguments about the global financial system that I have encountered in years of research for this channel. His core claim is this: boom and bust cycles are not accidents of human psychology. They are not gravity. They are not the inevitable result of irrational exuberance. They are structural events produced by the architecture of the system itself, and they happen when it is profitable for the architects to make them happen. He calls this the Great Reset, and if he is right, if the private credit bubble, the AI financing loop, and the fiscal architecture of the American empire are all converging toward a structural reset, then Bitcoin is not a speculation. It is not a trade. It is the only asset in the known financial universe that exists completely outside the system being reset. 21 million coins, no central bank, no BIS, no counterparty, no bailout, no trust required. Satoshi Nakamoto wrote this in February of 2009, just weeks after mining the first Bitcoin block with a headline embedded in the code. The Times, 3rd of January 2009. Chancellor on brink of second bailout for banks. He wrote, "The root problem with conventional currency is all the trust that is required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust." He was not writing about a financial instrument. He was writing about a system. And the system Satoshi was describing, the one built on layered trust, central coordination, and the structural ability to reset when needed, is the system Professor Jiang is mapping in this video. Now, before you decide whether to keep watching, let me tell you what this video is not. It is not a conspiracy theory. Every data point we use, the BIS, the private credit bubble, the AI financing loop, the Federal Reserve's balance sheet, the petrodollar architecture, is verified and sourced. Every claim is traceable to primary sources: government filings, peer-reviewed research, earnings reports, official central bank statements. If you want to buy Bitcoin, this video will tell you why the structural case for doing that right now is stronger than it has been since the spring of 2020. If you want to understand how a Bitcoin account on any major Bitcoin platform fits into a larger macro framework, this video will give you that framework. But this video is ultimately not about the Bitcoin price. It is about understanding the system well enough to know where value goes when the system resets. Because John Paulson did not make $20 billion by being smarter than everyone else. He made $20 billion by understanding which way the current was flowing. Before anyone else admitted the current existed, the current is flowing again. And the question, the only question that matters right now, is whether you are positioned on the right side of it. Let me show you the system.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you.
Okay, quick disclaimer. The macroeconomic and geopolitical analysis in this video is strictly for educational purposes and does not constitute financial advice. Trading and investing in Bitcoin and commodities during times of war involves extreme volatility and the risk of total capital loss. Therefore, you must prioritize strict risk management, disciplined position sizing, and your own due diligence, DYOR, before making any investment. These models are probabilistic, not guaranteed, and you are solely responsible for your financial decisions and the consequences of your trades. Stay sharp, use stop losses, and never invest capital you cannot afford to lose. Now let's continue. Before we go any further, I need to tell you who Professor Jiang is, and more importantly, who he is not. Because this is not a video about a prophet. It is not a video about a guru. And it is definitely not a video asking you to accept a framework uncritically because someone on the internet told you to. What it is about is a specific set of analytical tools, historical pattern recognition, game theory, and structural economic analysis that produced verified predictions before the events happened. Jiang Xueqin was born in Guangdong, China in 1976. His family immigrated to Canada at the end of the Cultural Revolution when he was 6 years old. His father became a short-order cook in Toronto. His mother worked as a seamstress, and Jiang grew up in conditions he has described as genuinely poor, including wearing hand-me-down clothes through school. He was rejected by MIT, Princeton, and Harvard before receiving a scholarship to Yale College, where he graduated in 1999 with a degree in English literature. This is the educational and biographical foundation of the man the internet now calls China's Nostradamus. His career after Yale was not a straight line. He struggled to publish after graduation, fell into severe depression, and spent years working small journalism jobs before relocating to Beijing in 2000. He was eventually deported from China in 2002 after being arrested while filming an undercover PBS documentary about labor protests. He was allowed back in 2003 and shifted from journalism to education, eventually rising to senior positions at some of China's most prestigious schools: deputy principal at Shenzhen Middle School, program director at Peking University High School, a researcher with the Global Education Innovation Initiative at Harvard Graduate School of Education, and a fellow of the Royal Society of Arts. Since 2022, he has taught history and philosophy at Moonshot Academy in Beijing, where his lectures on Western civilization and game theory are the raw material for the YouTube channel that now has over 2 million subscribers. His channel is called Predictive History. His methodology combines structural historical analysis, game theory, the mathematical framework that models strategic interactions between rational actors, and concepts drawn from Isaac Asimov's fictional psychohistory, the idea in Asimov's Foundation series that long-term historical patterns can be used to anticipate the future. He explicitly frames his lectures as speculation with empirical grounding, not prophecy, not certainty, but structured reasoning applied to observable patterns in history and political economy. On the specific financial system lecture that is the foundation of this video, he is direct about this framing. This is speculation for fun, for entertainment. Just see this as a fun class where we are going to explore some fun topics that have no scholarly basis. That disclaimer matters. Now, let me give you the honest bear case before we go any further into his framework. Critics, serious ones, have raised legitimate concerns about Jiang. The Free Press described him as a conspiracy theorist who has promoted unverifiable claims about secret societies controlling Western institutions. Wikipedia categorizes him explicitly as an educator and conspiracy theorist. His title of professor is contested. He holds a BA from Yale, not a PhD, and teaches at a high school, not a university. Most pointedly, critics have asked a question nobody in his comment section seems eager to ask. How does a man expelled from China for politically inconvenient journalism end up living and working in Beijing, producing content that consistently maps onto narratives of American decline and Western institutional collapse? That question has no clean answer, and this channel is not going to pretend it does. So let me tell you precisely how we use Jiang's framework in this video, and what we leave out. We use the structurally verifiable parts: the boom-bust cycle argument, the BIS as coordinator of central banks, the Glass-Steagall repeal, the 2008 consolidation of banking power, and the argument that the private credit bubble and the AI financing loop have structural properties similar to previous cycles. Every single one of those claims can be verified against primary sources: government filings, Federal Reserve data, academic papers, court documents, financial statements. We leave out the Illuminati, the secret societies, the specific actors he names as architects of deliberate collapse. Those claims are not verifiable. They are not necessary for the argument to function, and they would compromise the editorial standard this channel has maintained since its first video. What remains after that filter is not a conspiracy theory. It is a structural economic argument, one with a specific testable prediction about the relationship between the current bubble architecture the inevitable monetary reset it implies, and the one asset class that exists completely outside the system being reset. That asset is Bitcoin. And the argument for why you need to understand Jiang's framework before you make any decision about whether to buy Bitcoin, whether to open a Bitcoin account on any regulated Bitcoin platform, or whether to position a Bitcoin investment as part of a larger portfolio, is the argument this entire video is built around. He's not a prophet. He's not a professor in the academic sense. He's a very precise thinker with a documented track record of predictive accuracy on geopolitical events, who happens to have applied that same structural framework to the global financial system, and whose conclusion is the most uncomfortable sentence in modern finance. The system is not broken. It is designed to reset. And when it does, the question is not whether you will be affected. The question is whether you will be on the right side of the reset. Before we go any further, there is something you need to know about Professor Jiang and Bitcoin, because it matters for the integrity of everything that follows in this video. Professor Jiang is not a Bitcoin advocate. He is not a crypto investor. He's not telling you to open a Bitcoin account, make a Bitcoin purchase, or build a Bitcoin investment strategy of any kind. In fact, he has called Bitcoin, on camera, the biggest scam in existence, and has argued in separate lectures that it was created by the Pentagon as the ultimate surveillance technology. Those claims are not verified, and this channel rejects them. But the point stands and needs to be heard clearly. The man whose economic framework we are using to build the bull case for Bitcoin in this video thinks Bitcoin is a scam. We are not following Professor Jiang to Bitcoin. We are using his structural analysis of the financial system, the parts that are independently verified, and arriving at a Bitcoin conclusion that the data supports and that Jiang himself would probably dispute. That distinction is not a footnote. It is the entire editorial foundation of this video. Now, let us build the framework. Jiang opens his Great Reset lecture with a question that mainstream economics cannot cleanly answer. Why do bubbles pop? Every economics textbook will tell you the same story. Boom and bust is the natural rhythm of capitalism, the inevitable gravity of markets that have climbed too high. Andrew Ross Sorkin, one of America's most influential financial journalists, captured the mainstream explanation precisely in his book 1929, Inside the Greatest Crash in Wall Street History, which became a #1 New York Times bestseller in 2025. Sorkin wrote that lengthy, uninterrupted booms produce a collective delusion, that optimism becomes a drug or a religion, and that people lose their ability to calculate risk and distinguish between good ideas and bad ones. That explanation is coherent, well documented, and widely accepted in academic circles. It says that the bubble pops because of human psychology, overconfidence, collective hallucination, gravity. Jiang says that is the story they want you to believe. His alternative framework starts with a single observation about how banks actually work. When you deposit $1 million into a bank, and the bank lends out $1 million to an entrepreneur, the bank does not have $0. It has $2 million. The deposit and the loan, both recorded simultaneously as assets in the financial system. This is not a theory. It is the documented mechanism of fractional reserve banking, confirmed by the Bank of England itself in its own published research. The Old Lady of Threadneedle Street, founded in 1694 as a private bank, primarily to fund the English war effort against France, chartered by Parliament in exchange for financing that the Crown could not otherwise obtain, published a paper in 2014 titled Money Creation in the Modern Economy, which states explicitly that banks create money every time they make a loan, not by transferring existing deposits, but by simultaneously creating new deposits. The Bank of England said this publicly. It is not a conspiracy theory. It is monetary mechanics. But Jiang takes this one step further, and this is where the framework gets structurally interesting. If individual banks all have the ability to expand the money supply through lending, how do they coordinate? How does one bank know whether to expand credit or contract it at any given moment? His answer is the interest rate, not as a signal to consumers about whether to buy a house, but as a signal to banks about whether to release or restrict liquidity into the system. When the central bank lowers rates, banks collectively know to lend more, expanding the money supply. When the central bank raises rates, banks collectively know to tighten, contracting it. The interest rate is not a consumer signal. It is a coordination mechanism for the banking system as a whole. That reframing, verified independently by Federal Reserve research and central banking literature, changes the entire picture of how the economy actually functions. And then Jiang asks the next question: who coordinates the coordinators? If the Federal Reserve coordinates American banks and the Bank of England coordinates British banks, who coordinates all the central banks together? The answer is the Bank for International Settlements, the BIS, founded in 1930 in Basel, Switzerland. The BIS is not a conspiracy theory. It is a real institution, and the oldest international financial organization in the world, described on its own website as a bank for central banks. It has 63 member central banks, representing approximately 95% of global GDP. It holds its own assets in its own name, is legally immune from the jurisdiction of any national government under the 1930 Hague Agreement, and conducts its most important deliberations, the bimonthly meetings of central bank governors in Basel, without publishing minutes or making transcripts publicly available. Adam Labor documented this in Tower of Basel, a meticulously sourced investigative history published by Public Affairs Press in 2013, endorsed by Princeton University's Harold James as compelling reading. During the Second World War, the BIS accepted looted Nazi gold and conducted transactions for the Reichsbank while also maintaining channels with Allied powers. Facts confirmed by the BIS's own historical archive and never seriously disputed. Here is the part that connects this architecture to what Jiang calls the Great Reset, and where we need to be precise about which parts of his argument are verified and which parts are structural inference. What is verified? The BIS coordinates central banks. The interest rate mechanism coordinates individual banks within each national system. The exchange rate coordinates trade between national systems. These are not theories. They are the operational mechanisms of the global financial system, documented in central banking literature and academic economics. What is structural inference? Jiang's contribution, and the part we handle with editorial precision, is the argument that these coordination mechanisms can be and have been used to deliberately direct capital from one host economy to another, contracting one system while expanding another. He is not claiming that a secret committee meets in a room and votes on which country's economy to collapse. He is claiming something more structurally precise, that the incentives built into the system produce outcomes that benefit the architects of capital flows, and that the pattern of those outcomes, when examined across the 1929 crash, the 2008 crisis, and the post-2008 Chinese expansion, is too consistent to be purely accidental. Now, here's the bear case you need to sit with before we go any further into this argument. The structural critique of Jiang's framework is legitimate and important. India Today noted in its profile of him that other analysts had made similar geopolitical predictions, meaning his accuracy may reflect the density of forecasters rather than unique insight. His economic framework conflates structural incentives with deliberate agency, meaning it cannot distinguish between a system that produces these outcomes by design and a system that produces them as emergent properties of rational actors pursuing their individual interests. Those are very different claims with very different implications, and Jiang does not always make the distinction cleanly. When he says the system is engineered, he means something weaker than a coordinated conspiracy, but stronger than pure accident, and that middle ground is analytically valid, but rhetorically vulnerable to being misread in both directions. This channel reads it in the precise middle. The system has structural incentives that produce cyclical wealth concentration. Those incentives are not accidents. They are built into the architecture of central banking, fractional reserve money creation, and the BIS coordination mechanism. And understanding them is worth $20 billion, which is what the one man who understood them most clearly made in 2007 and 2008, while the rest of the world was watching the collective delusion unravel. Whether you decide to buy Bitcoin now, whether you choose to build a Bitcoin investment strategy, or whether you simply want to understand where money flows when systems reset, this framework is the analytical foundation. And in the next block, we show you exactly how this system has migrated from host to host across 3 centuries, and why the current architecture points unmistakably toward a reset that is already in motion. Let's do a quick pause. I want to speak directly to you. You are more than 10 minutes into a video about monetary history, central banking architecture, and geopolitical collapse cycles. There is no DJ drop. There is no countdown timer. There is no thumbnail promise of a number that will change your life by Friday. And you are still here? Do you understand how rare that is? The average YouTube video loses 80% of its audience in the first 2 minutes. The ones that make it to minute 10 on a video like this, no gimmicks, no shortcuts, just the argument, those are the people who actually change how they think about money. Those are the people who are still talking about what they learned 3 years from now. That is you, right now at minute 10. So before we go any further, I want to know who is in the room. Drop a comment right now. Tell me your city, tell me what time it is where you are, and tell me what the weather looks like when you look out your window. That is it. Nothing complicated. Just, where are you? When are you watching this? And what does the world look like outside right now? I read every single comment. Everyone. Now let's continue. Let me show you a pattern that runs across 3 centuries of financial history. Because once you see it, you cannot unsee it. The pattern is this. Capital does not stay in one place. It moves from host to host, carrying the same 3 operating principles wherever it goes. Profits are privatized, losses are socialized, and the mechanism that makes this possible is always a private institution with public legitimacy, chartered to create money on behalf of the state in exchange for the privilege of financing its wars. Every major transfer of economic gravity in the last 300 years has followed this same structural template. And every time it moves, it leaves behind a country that believes it won, a system that appears stable, and a set of bubbles that are waiting for their designated moment to collapse. The first transfer begins in 1688. The Glorious Revolution in England was not primarily a religious event or a constitutional one, though it was both of those things too. It was a financial merger. The Dutch Republic, at that moment the richest territory on earth because it controlled the global spice trade, had a problem. It could not defend itself. Catholic France and the Habsburg Holy Roman Empire were pressing it on every side. England had the Royal Navy and the geographic protection of being an island. The deal that emerged from this moment of structural necessity was the Bank of England, chartered in 1694 by Parliament, initially to raise £1.2 million in 11 days to finance King William III's war against France. The Bank of England's own website confirms the purpose explicitly. It was, in the bank's own words, primarily founded to fund the war effort against France. Capital from the Dutch Republic migrated into this new instrument, and the British Empire's 3 centuries of global dominance began, not because of superior technology or military prowess alone, but because of a financial architecture that guaranteed profits to lenders and socialized losses to taxpayers. The system had 3 rules that it carried with it wherever it went. Rule 1, lend to parliaments, not kings, because parliaments represent nation-states, and nation-states do not die. Rule 2, generate wealth through activity, wars, conquests, trade monopolies, because idle capital earns nothing and the system requires perpetual expansion. Rule 3, control the movement of capital across borders through open markets, because capital that cannot flow freely cannot migrate to where returns are highest. The British Empire's expansion, the Napoleonic Wars, the conquest of India, the Great Game in Central Asia, the opening of China, followed directly from these 3 rules. The system needed activity. Wars were the most reliable generator of activity. The second transfer begins in November of 1910. 6 men traveled in a private rail car from a New Jersey terminal to a private island off the coast of Georgia, under assumed first names only, using the cover story of a duck hunting trip. They were Nelson Aldrich, the Republican Senate Finance Committee chairman, and John D. Rockefeller Jr.'s father-in-law, Henry Davison, senior partner at J.P. Morgan, Frank Vanderlip, president of the National City Bank of New York, the institution associated with the Rockefeller family, Paul Warburg of Kuhn, Loeb and Company, A. Piat Andrew, assistant secretary of the Treasury, and Arthur Shelton, Aldrich's private secretary. The Federal Reserve History website at federalreservehistory.org confirms this meeting occurred and documents the participants, their affiliations, and the outcome. They worked for 9 days at the Jekyll Island Club and produced the draft legislation that, with minor amendments, became the Federal Reserve Act, signed by Woodrow Wilson on December 23, 1913. The Federal Reserve Act of 1913 did not create an institution that was neutral toward the interests of the banking system that designed it. Frank Vanderlip himself wrote in his 1935 autobiography, "Despite my views about the value to society of greater publicity for the affairs of corporations, there was an occasion near the close of 1910 when I was as secretive, indeed as furtive, as any conspirator." What emerged from Jekyll Island was a system modeled on the Bank of England, a central bank that coordinated thousands of private banks through the interest rate mechanism, socialized losses through the Federal Deposit Insurance Corporation and eventual bailouts, and kept the profits flowing to the private institutions that owned its regional banks. Capital from the City of London and the Bank of England migrated into this new American architecture. Chong uses the phrase agents of the City of London to describe Rockefeller, Morgan, Carnegie, and Vanderbilt. That framing is his, and it is structurally polemical. What is documentable and independently verified is simpler. The men who designed the Federal Reserve were the senior partners of the largest American financial institutions. They modeled it explicitly on European central banking, and they kept its design secret for 20 years because they knew its political passage required concealing whose interests it served. The third transfer is the one that produced the world you are living in right now. And it began, not in a private rail car, but in the rubble of the 2008 financial crisis. When Lehman Brothers collapsed in September 2008, and the American financial system required the largest government intervention in its history to avoid complete implosion, the global economy faced a demand crisis of historic scale. America was consuming less. Europe was consuming less. Someone needed to absorb the demand that had evaporated. The solution that emerged, whether deliberately coordinated or structurally incentivized, was China. The Chinese government announced a 4 trillion renminbi stimulus package in November 2008, equivalent to $586 billion and approximately 12% of China's GDP. To put that in scale, the American Recovery and Reinvestment Act of 2009 allocated around $800 billion, roughly 5% of US GDP. China's stimulus was more than twice as large relative to its economy. Bank credit in China more than doubled from 4.7 trillion renminbi in 2008 to 9.6 trillion renminbi in 2009 alone, confirmed by peer-reviewed research published in Science Direct. The money went into railways, roads, airports, hospitals, schools, and high-speed rail, the infrastructure of an economy positioning itself to become the world's manufacturing and export engine. China's GDP growth, which had fallen to approximately 6% in the first quarter of 2009, recovered to 10.7% by the fourth quarter of the same year. While the United States and Europe spent the next decade dealing with the aftermath of their debt crisis, China built the infrastructure of the next industrial age. The result of this transfer is visible in a single data point that Jiang uses in his lecture, and that is independently verified by S&P Global Market Intelligence, Statista, and every major financial publication. The 4 largest banks in the world by total assets as of 2024 are all Chinese. The Industrial and Commercial Bank of China at $6.3 trillion, the Agricultural Bank of China, China Construction Bank, and the Bank of China. J.P. Morgan Chase, the largest bank in the United States, ranks 5th globally with approximately $4.0 trillion in total assets. In 2008, the Chinese and American banking systems were approximately the same size. In 16 years, China's banking system became the largest on the planet. That is not a natural market outcome. That is a structural transfer of financial gravity. One that Jiang argues was coordinated through the BIS exchange rate signaling mechanism, and one that the data on Chinese bank credit expansion and infrastructure investment fully corroborates, regardless of whether one accepts or rejects his more speculative claims about deliberate orchestration. Now here is where the framework arrives at the question this entire video is building toward. If the pattern of the last 3 centuries is that capital migrates from host to host, when the current host becomes too old, too indebted, too incapable of generating the activity the system requires, then the question for the investor who understands this pattern is not whether the next migration will happen. It is what happens to Bitcoin during the period of maximum turbulence between the old host and the new one. And here's the bear case you need to sit with. Jiang himself, as we established in the previous block, believes Bitcoin is a Pentagon surveillance tool and the biggest scam in existence. The conclusion this channel draws from his framework, that Bitcoin is the one asset that exists outside every host system and therefore cannot be confiscated, cannot be rolled into the reset, and cannot be debased by whoever runs the next central bank, is a conclusion Jiang did not draw and would probably dispute. We are using his map to navigate to a destination he has never visited. That is not a weakness of the argument. It is the clearest possible statement of where this channel's analysis ends and Professor Jiang's begins. The reset is structural, the bubbles are loaded, and the question of whether to buy Bitcoin, whether to open a Bitcoin account on a regulated Bitcoin platform, and whether a Bitcoin investment belongs in your portfolio, is the question that the next 3 blocks of this video will answer directly. Professor Jiang's framework arrives at a specific and uncomfortable prediction. Before capital migrates from one host to the next, it needs a collapse event. The collapse is not accidental. It is the mechanism through which assets are repriced, weak hands are shaken out, and the architects of capital flows accumulate the distressed assets they need to anchor the next expansion. The 2008 crisis followed this pattern precisely. Homes owned by individuals were lost to institutions. Bear Stearns and Washington Mutual were acquired by J.P. Morgan for fractions of their pre-crisis values, and the concentration of financial power that emerged from the wreckage was orders of magnitude greater than what existed before the crisis began. The question Jiang poses for the current moment is not whether a similar event is coming. His question is, which bubbles are available to pop when the time comes? He identifies 3. And in the spring of 2026, all 3 are simultaneously under stress. The first bubble, private credit. The private credit market did not exist at meaningful scale 15 years ago. The Federal Reserve Bank of Boston documented that U.S. private credit grew from $46 billion in the year 2000 to roughly $1 trillion by 2023, with the most explosive acceleration happening after 2019. The IMF's April 2024 Global Financial Stability Report placed global private credit assets and undeployed commitments at approximately $2.1 trillion, a market that now rivals 3/4 of the entire global high-yield bond market in size. By the start of 2025, industry estimates placed the total at $3 trillion globally. By 2029, it is projected to reach $5 trillion if current growth trajectories hold. What is private credit precisely? It is direct loans made by non-bank institutions like Apollo, Ares, Blackstone, and Blue Owl to mid-sized companies that do not have access to public debt markets. The loans are not publicly traded. Their valuations are assessed infrequently and subjectively. The interconnection between these funds, the insurance companies and pension funds that invest in them, and the banks that provide them with senior credit lines is opaque enough that even the IMF has acknowledged it cannot fully map the systemic exposure. The Federal Reserve's own research published in May 2025 documented that large US and European banks have $4.5 trillion of exposure to all non-bank financial intermediaries, including private credit. That number is larger than the GDP of Japan. When those banks lend to private credit funds and those funds lend to companies that cannot service their debt, the chain of liability runs through institutions that taxpayers are expected to bail out when they fail. The stress signals in this market are already visible. The private credit intelligence firm With Intelligence reported in early 2026 that the headline default rate for private credit has remained below 2%, but that the true default rate, when liability management exercises, payment in kind toggles, and selective defaults are included, approaches 5%. Goldman Sachs disclosed that approximately 15% of private credit borrowers are no longer generating enough cash to fully service their interest payments. In February 2026, Blue Owl Capital, Ares Management, and Apollo Global Management all restricted investor withdrawals, a signal that liquidity is under pressure. Jamie Dimon, CEO of JP Morgan, warned publicly that First Brands and Tricolor, the two high-profile private credit collapses of late 2025, might be cockroaches, the visible failures above a much larger hidden problem below. The bear case here is legitimate and must be stated precisely. CNBC published an analysis on March 30th, 2026, the most recent before this recording, with the following headline: Private credit fears have ripped through Wall Street in 2026. Why they may be overblown. The core argument: the investor base for private credit is primarily institutional, with long lockup periods that prevent the bank run dynamic that destroyed 2008. Dan Greenhouse of Solus Alternative Asset Management told CNBC, the equation to 2008 is misplaced. That distinction matters. Jiang's framework does not require private credit to collapse in the 2008 manner. It requires only that the collapse, when it comes, is profitable for the right people. And when 15% of borrowers cannot pay their interest, when the big five private equity managers restrict withdrawals, and when the Iran oil shock is adding pressure to every leveraged capital structure on Earth, the conditions for a controlled collapse are assembling. The second bubble: artificial intelligence. The AI financing structure that is built up since 2023 is, by the documented analysis of multiple mainstream financial institutions, a circular loop that shares structural DNA with the worst episodes of the dot-com bubble. With one significant difference: it is happening at 10 times the scale. Here is the loop, documented by Bloomberg, Fortune, NPR, NBC News, Harvard Business School, and Wikipedia's AI bubble article, all citing the same underlying transactions. NVIDIA invests $100 billion in OpenAI. OpenAI uses those funds to build data centers filled with NVIDIA's own chips. NVIDIA simultaneously holds a 7% stake in CoreWeave, a cloud computing company. OpenAI commits $22.4 billion in contracts to CoreWeave for GPU infrastructure. NVIDIA agrees to purchase $6.3 billion in cloud services from CoreWeave through April 2032, guaranteeing to buy CoreWeave's unsold capacity. CoreWeave carries $10.45 billion in debt using NVIDIA GPUs as collateral. Microsoft owns 27% of OpenAI and represents nearly a fifth of NVIDIA's revenue. In October 2025, OpenAI purchased billions of dollars in electronics from AMD, making OpenAI one of AMD's largest shareholders, while simultaneously becoming one of AMD's largest customers. This is not a technology company ecosystem. It is a closed financial circuit where every participant is simultaneously a customer, a supplier, a lender, and an investor in every other participant. Michael Burry, the investor who shorted the 2008 housing crisis and was immortalized in The Big Short, described the structure bluntly on X. True end demand is ridiculously small. Almost all customers are funded by their dealers. OpenAI CEO Sam Altman himself admitted publicly in August 2025. Investors as a whole are overexcited about AI. OpenAI reported losses of $7.8 billion in the first half of 2025 on $4.3 billion in revenue. The company projects operating losses of $74 billion in 2028. Deutsche Bank analyst Jim Reed estimated OpenAI's cumulative losses between 2024 and 2029 at $140 billion. OpenAI committed to spending $1.4 trillion over 8 years on data centers, funded by debt, against $13 billion in annual revenue. The bear case: The 5 largest tech companies funding this expansion, Microsoft, Alphabet, Amazon, Meta, NVIDIA, are generating real revenue, real earnings, and have deep cash reserves that insulate the hyperscaler layer from the failure of any individual AI lab. The infrastructure, even if overbuilt in the near term, may ultimately be justified by the long-term productivity gains of AI. The dot-com bust destroyed individual companies, but built the internet infrastructure that created $10 trillion in value over the subsequent decade. NVIDIA is real. The chips are real. The demand for compute is real. What is not yet real is the revenue model that justifies the debt structures that private credit is financing to build the data centers that NVIDIA is guaranteeing to fill with chips it is selling to customers it is also funding. When that chain snaps, if it snaps, the question of who holds the distressed assets of the AI infrastructure build-out will answer itself quickly. The third bubble, American fiscal architecture. The third bubble is not a market in the traditional sense. It is the architecture of the American fiscal state itself, and it is the one that Jiang argues is the actual mechanism of the reset, because it is the one that cannot be rolled over indefinitely without triggering the debasement event that drives Bitcoin. The United States national debt crossed $39 trillion on March 18, 2026. The Congressional Budget Office projects net interest payments will rise from $1 trillion in fiscal year 2026 to $2.1 trillion by 2036. Interest costs are already the third largest line item in the federal budget, behind only Social Security and Medicare, larger than defense spending, larger than education, larger than all discretionary spending combined. The debt is growing at $7.23 billion per day. The average interest rate on marketable debt is 3.355%, compared to 1.512% 5 years ago. Every tenth of a point by which rates stay elevated costs the Treasury billions of additional dollars per month in carrying costs on the existing stack. The connection to the first 2 bubbles is precise and structural. If private credit collapses and triggers a financial crisis, the government responds with bailouts and stimulus, adding to the debt. If the AI bubble deflates and the private credit that financed the infrastructure build-out goes bad, the sovereign backstop arrives, adding to the debt. And if the Iran war continues, with Stage 3 potentially extending the conflict from months into years, every additional week of military operations costs approximately $3.7 billion per 100 hours, all of it unbudgeted, all of it financed through new Treasury issuance, all of it landing on top of a debt pile that is already growing at a rate that no serious economist describes as sustainable. The bear case on the fiscal architecture is the same bear case that has existed since 2008 and has been wrong every year. The dollar remains the world's reserve currency, and reserve currency status grants the United States the structural ability to finance its deficits at rates that would destroy any other sovereign borrower. Dollar doomsayers have been wrong for 50 years. This is true. But the petrodollar architecture that underwrites dollar reserve status is under active stress from the Iran war, Saudi Arabia's membership in the Enbridge yuan-based payment system, and Deutsche Bank's March 2026 analysis calling the conflict a potential catalyst for the beginnings of the petroleum. The question is not whether the dollar collapses this year. The question is whether the direction of travel has changed and whether the rate of change is now fast enough to matter to anyone who wants to buy Bitcoin now, open a Bitcoin account, or begin building a Bitcoin investment strategy before the next cycle activates. Before we talk about Bitcoin as an investment thesis, before we talk about whether to buy Bitcoin, whether to open a Bitcoin account, whether to build a Bitcoin investment strategy, we need to establish something structural that no other asset can claim. Every asset that has ever served as a monetary anchor was itself embedded inside a host system. Gold was embedded inside sovereign vaults and central bank balance sheets. Its price controlled, its movement taxed, its ownership confiscated by executive order in 1933 in the United States and across most of Europe during wartime. The Bank of England held British gold. The Federal Reserve held American gold. The BIS coordinated the movement of gold between them. Gold was always inside the system, subject to the rules of whoever controlled the system. Bitcoin is the first monetary asset in recorded history that has no host. It has no central bank. There is no Bank of Bitcoin, no BIS equivalent, no body that sets its interest rate or determines its exchange rate. It has no government issuer, no parliament chartered it, no king signed its founding document. It has no counterparty. When you hold Bitcoin in self-custody, there is no institution on the other side of that position that can fail, freeze, or confiscate it. And it has a fixed supply that is enforced not by political promise or institutional restraint, but by mathematics and decentralized consensus running simultaneously on tens of thousands of nodes across every jurisdiction on Earth. The 21 million coin limit was hard-coded by Satoshi Nakamoto from the Genesis block in January 2009. As of 2025, 19.8 million Bitcoin had already been mined. Fewer than 1.2 million coins remain to be issued. The last one will be mined around the year 2140. And no central bank, no government, no BIS working group, and no emergency executive order can change that schedule without convincing tens of thousands of independent node operators worldwide to voluntarily adopt software that would harm their own holdings. The April 2024 halving reduced the block reward to 3.125 Bitcoin, cutting new supply creation in half overnight, programmatically, without any committee vote, without any emergency meeting, without any phone call between Jerome Powell and Janet Yellen. That is not a policy. It is not a regulation. It is arithmetic. And the contrast with every other monetary system that has existed since 1694 is total and complete. The Bank of England printed money to finance wars because it was designed to do exactly that. The Federal Reserve expanded its balance sheet from $4 trillion to $8 trillion in 2020 because that is what it was designed to do: coordinate liquidity across the system in response to crisis. Bitcoin was designed to do the opposite, to issue its last coin according to a fixed schedule, regardless of whether the world is at war, in recession, or in the middle of the largest institutional accumulation wave in its history. Here's the distinction that most people who talk about Bitcoin get wrong, and getting it wrong leads to wrong predictions. Bitcoin is not an inflation hedge. It is a monetary debasement hedge. Those two things are different, and the difference is precisely why 2022 looked like a refutation of Bitcoin's entire monetary thesis and was not. In 2022, consumer inflation ran above 8% in the United States, the highest in 40 years. Bitcoin fell 77% from its peak. Gold held up. Bitcoin collapsed. If your thesis was that Bitcoin tracks inflation, 2022 destroyed that thesis with a sledgehammer. But if your thesis is that Bitcoin tracks global monetary debasement, the expansion of money supply, not the rise of consumer prices, then 2022 was not a refutation at all. It was a data point in perfect alignment with the model. The Federal Reserve in 2022 was not expanding the money supply. It was contracting it, raising rates from near 0 to 4.5% in the fastest tightening cycle in 40 years, reducing its balance sheet, draining liquidity from the global financial system. Bitcoin tracked global M2. When M2 contracted, Bitcoin fell. When M2 expanded, 2020 through 2021, when the Fed balance sheet doubled in 18 months, Bitcoin rose from $3,800 in March 2020 to $69,000 in November 2021. A peer-reviewed paper published on SSRN in August 2025, analyzing Bitcoin price dynamics from 2009 to 2025, found correlation coefficients between global M2 growth and Bitcoin price appreciation, reaching 0.78 during the 2020 to 2023 period, with approximately 90-day lag effects. A separate quintegration analysis published on preprints.org in June 2025, using 10 years of data from 2015 to 2025, found a long-run elasticity value of 2.65, meaning that for every 1% increase in global M2, Bitcoin historically moved 2.65% in the same direction over a trailing window. The analysis used Engel-Granger quintegration methodology, the standard academic framework for identifying long-run relationships between macroeconomic variables. CF Benchmarks, the institutional index provider that calculates the reference rate used by CME Bitcoin futures and BlackRock's IBIT ETF, documented a similar pattern independently. Bitcoin responds to global liquidity with a lag of approximately 56 to 60 days. And the correlation over the 2020 to 2025 period is consistent and measurable. By 2025, global M2 had reached $113 trillion. When the system engineers its next expansion, when the Federal Reserve pivots, when Treasury prints to finance the war, when the BIS coordinates a coordinated global stimulus in response to private credit collapse, the clock on Bitcoin's next cycle does not start when the news breaks. The clock started 56 to 60 days before Bitcoin moves. That lag is the window. And the institutional investors who understand this framework are not waiting to read about it in a headline. By 2026, something has shifted in the structure of Bitcoin's ownership base that makes every previous cycle incomparable to what is building now. BlackRock's iShares Bitcoin Trust, IBIT, held approximately 777,000 Bitcoin as of mid-March 2026, representing roughly $52.8 billion in assets under management and making it the single largest Bitcoin ETF globally. That is not a small fund. That is the world's largest asset manager, managing trillions of dollars across every asset class, choosing to build a Bitcoin product and accumulate more Bitcoin than any institution outside of early miners has ever held. HIBIT recorded $8.4 billion in net inflows in the first quarter of 2026 alone, the best quarter for a single Bitcoin ETF in history. Larry Fink, BlackRock's CEO, publicly stated that sovereign wealth funds allocating 2 to 5% of their portfolios to Bitcoin would drive Bitcoin's price to levels that would rewrite the historical record. He has called Bitcoin an asset of fear, an asset whose structural scarcity makes it the destination for capital that does not trust the monetary system in which it is currently stored. Strategy, the publicly traded company formerly known as MicroStrategy, led by Michael Saylor, held 762,099 Bitcoin as of March 23, 2026, acquired for approximately $57.69 billion at an average cost of $75,694 per coin. Strategy continued to add to its position even during the Iran war sell-off, purchasing 1,031 additional Bitcoin in the week of March 16th to March 23rd at an average price of $74,326. This is not a momentum trade. This is a structural conviction that the monetary system is debasing itself, and that the only asset outside that system is the correct destination for treasury capital. The Czech National Bank made international headlines in early 2026 by purchasing Bitcoin, the first central bank in the world to experiment with blockchain-based digital assets as a reserve position, as documented by Deutsche Bank and multiple institutional research publications. The bear case on institutional adoption must be stated directly. Bitcoin fell more than 40% from its record high of $126,000, reached in October 2025, to below $63,000 on the day the Iran war began, February 28, 2026. Strategy's average cost basis of $75,694 sits above the current price as of this recording. BlackRock's IBIT posted a negative 21.63% year-to-date NAV return as of March 26th. The institutional base has not protected Bitcoin from drawdown. It has stabilized the floor relative to previous cycles. The Fear and Greed Index hit a record low of 5 in February 2026, lower than the COVID crash and lower than the FTX collapse, yet Bitcoin held above $63,000. But it has not made Bitcoin immune to the correlation with equities that makes it behave like a risk asset in the first phase of a geopolitical shock, before the monetary implications of the shock become the dominant market narrative. Here is where Professor Jiang's map and this channel's destination meet. Jiang's framework says the system migrates from host to host when the current host becomes too old, too indebted, and too incapable of generating the activity required for the system to sustain itself. He identifies 3 bubbles available to collapse: private credit, artificial intelligence, circular financing, and the American fiscal architecture. He argues that the Iran war is the geopolitical catalyst that accelerates the timeline of fiscal deterioration, petrodollar erosion, and capital flow reallocation. He does not argue that Bitcoin benefits from this. He argues that Bitcoin is a surveillance tool designed by the Pentagon, and this channel has already told you that clearly and will not repeat it. What this channel argues, using Jiang's framework as the structural foundation and independent verified data as the evidentiary base, is something specific and falsifiable. When the system resets, it needs a new host. Every previous reset had one: the Bank of England in 1694, the Federal Reserve in 1913, the Chinese banking system post-2008. Each new host was a new private institution with public legitimacy, chartered to create money in service of state financing, subject to the 3 rules of the system: profits privatized, losses socialized, capital flows coordinated by the BIS. The question this channel is asking is not which country becomes the next host. The question is, what happens to the capital that does not want to migrate into the next host? What happens to the wealth that has lived inside the American financial system for decades and does not trust that the transition from American hegemony to whatever comes next will preserve its purchasing power? Where does that capital go when it does not want to follow the BIS's next coordination signal? Since the Iran war began on February 28, 2026, Bitcoin is up 12%, gold is down 16%, the S&P 500 is down 4%. That data point is from River Financial as of March 23, 2026, confirmed by BingX market data and reported by multiple financial publications. JP Morgan noted on March 30th, the day before this recording, that Bitcoin is weathering the Iran crisis better than gold and silver, a notable observation given that gold's unprecedented losing streak has been the single most disorienting signal in global markets for weeks. Gold fell during an active war. Bitcoin held. The traditional safe haven failed to perform its traditional function. The asset that was supposed to be the volatile one demonstrated horizontal stabilization, while equities formed a downtrend. The crypto fear and greed index hit extreme fear. Funding rates turned negative, Sentiment reached its lowest recorded level, and yet the price held above $63,000 and recovered towards $71,000, while institutions accumulated through the ETF wrappers that now give them 24/7 access to Bitcoin without ever touching a self-custody wallet. Here is the full bear case, stated precisely and without softening. First, Bitcoin fell 40% before the Iran war from its all-time high, and institutional adoption did not prevent that. Second, in the first hours of the conflict, Bitcoin sold off alongside equities, the reflexive market behavior of a risk asset, not a safe haven. Third, the 2022 cycle showed that when the Fed tightens in M2 contracts, Bitcoin can fall 77% regardless of inflationary conditions. Fourth, if the Iran war ends quickly, if a ceasefire is announced before Jiang's structural premises have time to activate fully, the primary geopolitical driver of this thesis resolves without the fiscal deterioration and monetary expansion it was expected to generate. Fifth, correlation between Bitcoin and the NASDAQ 100 was measured at 0.72 as of early 2026, meaning Bitcoin still trades as a technology risk asset in the minds of many institutional allocators, not as a monetary hedge. If equities decline sharply in a private credit collapse scenario, Bitcoin is unlikely to be immune. Satoshi Nakamoto published the Bitcoin white paper on October 31st, 2008, 36 days after Lehman Brothers filed for bankruptcy. The Genesis block of the Bitcoin network, mined on January 3rd, 2009, contained a message embedded in its Coinbase transaction. The Times 03/January/2009 chancellor on brink of second bailout for banks. That was not an accident. It was a founding document. Satoshi was not building a currency for the next bull market. He was building a monetary architecture for the moment when trust in the existing system reached its breaking point, when the central banks had debased their currencies once too often, when the losses had been socialized once too many times, when the interest rate coordination mechanism had been stretched beyond what any institution could credibly maintain. Satoshi's own words from a post on the P2P Foundation in February 2009, "The root problem with conventional currency is all the trust that's required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust." That is the bridge. Professor Jiang gives you the map of how trust in the current monetary architecture collapses. Satoshi gave you the exit before that architecture was fully built. The question, the one that every person watching this video has to answer for themselves, is whether to open a Bitcoin account, how much of their portfolio to allocate to a Bitcoin investment, and whether the next 56 to 60 days of global M2 expansion represents the window they are willing to act in. This channel does not give price targets. It gives you the framework, and the framework is now complete. Let us compress everything this video has built into the 3 layers it actually contains. Because if you have watched this far, you deserve the argument stated plainly, without decoration. Layer 1 is Professor Jiang's framework. Financial collapses do not happen accidentally. They are engineered, not necessarily by a committee of villains, but by a system whose structural incentives produce the same outcomes as deliberate design would produce. Capital migrates from host to host. The Bank of England in 1694, the Federal Reserve in 1913, the Chinese banking system post-2008. Each migration was preceded by a period of maximum stress in the old host. Debt that could not be repaid, wars that could not be won, bubbles that could not be sustained without the very financing mechanisms that made them unsustainable. Each migration made the architects of the transfer wealthy beyond the imagination of the people who lived through the crisis itself. Jiang does not know what the next host is. And he does not think Bitcoin is part of the answer. We have told you that 3 times in this video because it matters. Layer 2 is the 3 bubbles that are loaded right now, simultaneously, in the spring of 2026. Private credit, $3 trillion globally, with a true default rate approaching 5%, with the largest managers restricting withdrawals, with $4.5 trillion in bank exposure to non-bank financial intermediaries that the IMF cannot fully map. The AI circular financing loop, $100 billion from NVIDIA into OpenAI, $22.4 billion in OpenAI contracts to CoreWeave, $6.3 billion in NVIDIA guarantees to CoreWeave, $10.45 billion in CoreWeave GPU-backed debt, and $140 billion in projected cumulative losses at OpenAI between 2024 and 2029, all held together by the assumption that revenue will eventually justify the debt. The American fiscal architecture, $39 trillion in national debt, growing at $7.23 billion per day, with net interest payments projected to reach $2.1 trillion by 2036, and an Iran war adding unbudgeted military expenditure on top of a fiscal structure that was already structurally insolvent before the first missile was fired. These 3 bubbles do not need to collapse simultaneously. They need only to create enough fiscal pressure that the monetary response, the only response any system has ever made to a crisis of this scale, produces the expansion of global M2 that has historically preceded Bitcoin's largest moves by 56 to 60 days. Layer 3 is Bitcoin's position in this architecture. It is not inside the system. It has no central bank. It has no BIS. It has no counterparty. It has no government issuer. Its supply is fixed at 21 million coins by mathematics and decentralized consensus, enforced by tens of thousands of independent nodes across every jurisdiction on Earth. No emergency executive order can change that. No BIS coordination meeting can redirect it. No Glass-Steagall repeal can expose it to the risks of the banking system it was designed to exist outside of. When Satoshi encoded the Genesis block message, Chancellor on brink of second bailout for banks, he was not making a political statement about the Bank of England. He was building an exit from a system that had operated by the same three rules since 1694. Profits privatized, losses socialized, capital flows coordinated by institutions that answer to no one but the system itself. What to monitor from this point forward, not as price signals, but as structural indicators that the framework is activating or failing to activate. Watch private credit default rates. The with intelligence true default rate of 5%, when liability management exercises and payment in kind toggles are included, is the number that matters, not the headline rate of 2%. If that number moves to 7 or 8%, and the big managers cannot contain the withdrawals, the fiscal backstop arrives. Watch AI revenue against debt obligations. OpenAI's revenue trajectory against its $1.4 trillion data center commitment and $74 billion projected 2028 operating loss is the single most important ratio in technology finance right now. If revenue does not close that gap by 2027, the circular financing loop unwinds. Watch the Federal Reserve balance sheet direction. The current level of $6.5 trillion is the floor. The question is whether the Iran war, a private credit stress event, or an AI infrastructure crisis forces the Fed to expand that balance sheet again. Because that expansion, historically, is the signal that the Bitcoin M2 lag clock starts. Watch on-chain accumulation data. As of late March 2026, Whale addresses holding between 10 and 10,000 Bitcoin increased their collective holdings by 61,568 coins over the prior month, a ratio of approximately 290 to 1 against retail selling. Long-term holders control over 78% of the total supply. Exchange reserves have fallen to 7-year lows. These are not price predictions. They are supply signals, the kind of structural data that tells you what the holders who have been through multiple cycles are doing, while the fear and greed index reads extreme fear and retail sentiment collapses. This channel does not tell you that Bitcoin will reach a specific price. It tells you that the framework this video has built, Jiang's structural analysis of host migration, the three bubbles, the 56 to 60-day M2 lag, the institutional accumulation base, and Bitcoin's unique position as the only monetary asset that exists outside every host system, points to a specific structural moment. That moment is not tomorrow. It is not certain. The bear case is real. The Iran war could end quickly. The private credit stress could resolve without a systemic event. The AI infrastructure build-out could eventually generate revenue that justifies the debt, and the dollar could remain the world's reserve currency for another decade through structural advantages that dollar doomsayers have underestimated for 50 years. Any of those outcomes would delay or invalidate parts of this thesis. The framework does not guarantee an outcome. It maps the terrain. If this framework resonates with you, if you are the kind of person who watches a 40-minute analysis of monetary history, bubble mechanics, and on-chain data and finds it clarifying rather than exhausting, then there are 3 things you can do right now. You can research how to open a Bitcoin account on a regulated exchange in your jurisdiction. You can educate yourself on self-custody, on what it means to hold Bitcoin in a hardware wallet where no institution stands between you and your coins. And you can watch the structural indicators this video has given you month by month and evaluate whether the framework is activating or whether the bear case is proving more durable than the thesis anticipated. This channel does not manage your portfolio. It builds the map. You decide where to go. Do you realize how rare you are? This video is 1 hour long of monetary history, bubble mechanics, and on-chain data. The average person on YouTube leaves in the first 3 minutes. You stayed for the whole map. That is not a small thing. That is the difference between the person who understands what is happening and the person who reads about it in a headline 2 years from now and wonders how they missed it. If you made it here, comment, "I see the game below." I read every single one. Again, drop the comment, "I see the game below." I read every single one, and don't forget to put the place and the hour you're watching from. Take care. I see you in the next video. Diamond.